And greetings from Austin, Texas. I am Mike O'Connor, a independent retail trader who's been trading with my partner from Denver, Colorado, Double A, Aaron Montel. I think we're celebrating our 11th anniversary this year.
Are we? Has it
We
been
are.
11 years? Wow.
Yep. And so you may be joining us from one of three different products. Double A hosts, and I'm a guest on his regular podcast called Macro Monkeys. You may know us from our stint as Chaikin Power Users. We're still Chaikin Power Users. We just no longer have an affiliate arrangement with Chaikin, but we since they've sold that to Stansberry Research. But we still swear by the application, use it all the time in our trading due diligence, and of course, we get access to a complimentary subscription in exchange for our unbiased opinions, which are always very good. And finally, welcome premium subscribers to our premium stock cheat sheets at substack.com. And this gives you a little extra insight because we're going to be able to give you a sneak peek under the hood of the Chaikin Analytics app, which adds a whole level of fundamental metrics that give traders an edge to go along with the cheat sheet subscription you have, which allows you to see relative strength rotation and some proprietary watch lists that are founded not necessarily on Chaikin data, but on a series of different fundamental reports. So a lot of different constituencies to serve here, Double A, and not everybody's going to have a screen. So we're going to have to be TV play-by-play and radio play-by-play at the same time to hopefully stay relevant to all of our, all three people, each of which is using a different product of ours.
I think a task we can handle. At least I hope so.
It is. Okay, so let's start with we're macro monkeys, but let's start with the elephant in the room down the street at the zoo. We have a market just sitting on support and a whole hell of a lot of macroeconomic risk out there. Not the least of which is a bald guy in the Eastern Europe or east of Europe with his finger on a nuclear button.
Yeah, I mean, I was going to say macro risk and geopolitical risk, right? With some geopolitical developments over the weekend, we'll have to see how those play out, later this evening and tomorrow.
And I'm surprised that we're even dealing with a VIX that's only in the low 30s.
Yeah, I mean, the VIX is interesting. It seems to keep coming up on that 35 number and being rejected, which is, again, what we've seen recently.
It does. It seems as though at least it's making another run to kind of coil up like a spring between 30, let's call it 29 and a half and maybe 34 and a half, something like that, where we're building some upward pressure. Now that's happened a few other times before. And each time we've then had a pretty significant rejection and a market rally that's lasted, anywhere from 2 to 8 weeks. Depending upon which stage of the bear market we were in. If you remember, shortly after the war broke out in Ukraine, after we all panicked, there was a little bit of a run that lasted about a month. And then, of course, things got choppy again through May. We hit bottom, right around June 15th. And we ran really all summer long until we got to Labor Day, when we think the big money came back from vacation and just slammed down the market. And so we've really gone nowhere, Double A, for the last 4 months.
Yeah, I mean, with an elevated VIX going nowhere is great for a premium seller, but it seems to me that a lot of this is being driven by Fed talking heads. It's the Fed is driving the cycle in the VIX and driving the cycle in the market, and by design, I'm sure. But I'm guessing, my opinion, it's a little ridiculous that this is the world we live in now. As we wait to hear and hang on every word of these Fed people.
It basically represents an economy that we as Americans throughout the Cold War rejected, a planned economy, correct? We basically have, 11 guys? How many active voters are, if you know?
I actually don't know. I think it might be, I'm trying to say 8, but I don't know. I don't know.
Well, it's about, about a baker's dozen.
Yeah, whether it's 1 or 8 or 11, they're all unelected officials at the switches with tremendous power. That it's becoming a little ridiculous.
Basically governing our economic cycles, and unfortunately, we need them because I think the markets are to the point where it's so distorted that the natural remedy of having markets come back into equilibrium where currency, good, and services all balance themselves out on their own, that is not going to favor the United States or our economy. And so we're left with basically these Fed folks with their finger on a button. It's not the nuclear button, but it's the next best thing, I guess.
Or worse
Great
thing.
Depression or hyperinflation. What do we want this week? Well, we kind of crashed the market for the last month. We better put a little hyperinflation. That's honestly my opinion of why this market break turned into a failed breakdown. But you'll notice that what didn't happen, AA, and we've both been doing this a long time, is that when the market, and we're talking about, kind of a classic key support level of around 3650, give or take, on the S&P, that we had a failed breakdown a week ago Friday. Well, we had a breakdown a week ago Friday, and then a huge reversal, but it lasted exactly 2 days. There was no rhyme or reason for it other than, I guess, we were oversold. Right. But we didn't have that continuation rally like we'd normally get right after a failed breakdown. We essentially U-turned, and by Friday, we were pretty close to getting back to where we were. Luckily, some buyers did come in the last few minutes of the market, so it kept, for those of you who follow cheat sheets, some of our junior timeframe indicators that kind of differentiate markets that puke everything up right into the close. We didn't have that. We did have some buyers come in, and I would say the technicals kind of favor the idea of meandering more so than a big swoop down, at least not until we get some market moving data, which we've got coming up toward the end of next week.
Yeah, we're again right at that key level. We ended the week right at that key level you described, and I agree with the assessment that we're probably going to meander around for several days, waiting for CPI, which is coming. What is it, on Thursday of this week? We're going to get CPI for September, which, I mean, that's going to have the potential for a big move.
So the CPI is the Consumer Price Index, and it's one of the key inflation gauges that the Fed pays attention to, and particularly core CPI, right? The one that factors out the expenses that the rest of us normal people are subject to every month, but apparently doesn't count toward inflation.
Right. And it was just real quick, which you're referring to food and energy or those things. And recently Jerome Powell was asked why he prefers PCE, or the Fed prefers PCE. And he came out, he flat out came out and said it's because their tools are ineffective against food and energy. So we'll just ignore them.
We need to regauge our activity to the report cards that drive our bonus.
Yeah.
Yep. Crazy. Both of us came from radio. And I know we have a lot of followers from the radio industry because that's where a lot of our relationships are. And for those of you who are in that business, there's a difference between regular radio listeners or TV viewers and the people, this tiny subset of the market, the tenths of a percentage point that are likely to participate in the Nielsen ratings. And those media industries super serve that minor audience because that's how their economics are measured. Now, of course, the Fed they don't have bonuses for being in government services, but they have legacies, correct? And so it's all about moving those key metrics and not necessarily about the health of and wealth of the average American.
Right.
Yeah.
So
Consumer Price Index is actually expected to be a little hotter, which I kind of find interesting. I think that we moved in reality up 0.1%. I'm talking about the non-core Consumer Price Index once you factor in food and energy. But they're expecting a hotter number coming up here in September. And that is honestly before gas prices started to run again, which we're at the beginning stages of.
Yeah, gas is coming out of nowhere again as far as prices. I saw California last week recorded a record high price for an average gallon of gas in California. I saw some like $8-9, something ridiculous, and just kind of out of nowhere. And something to watch this week and remember is that the month we're losing in 2021, the month of September 2021, was one of the lower months. So we're dropping what is it? I'm looking at right now. 0.3 is what we're replacing. So, anything above that is going to be a year-over-year increase, right?
Yeah, that's right. Now, see, so if the experts' forecast comes in line, I'm now talking about CPI year over year. Our year over year number for last month, where we had CPI increase by 0.1%, our inflation year over year number was 8.3%. If the experts are right and we only go up 0.3%, that year over year is 8.1. So it'll actually show a slight decline in inflation. But quite honestly, this core CPI, which strips out energy, is actually expected to go up more dramatically, 6.3 to 6.6 year over year. So definitely mixed signals. We've got the Fed just, I think it's what, 80% probability of a 75 basis point hike in December, correct? I think that's what I saw.
In November, you mean?
Oh, is it November? Is that their next meeting? It's
I believe it's just after the election. Yeah.
Right. Yep. So mid-November we go up. That's right. And then there's another meeting in early January. That's right. So this is the last meeting of the year, I believe, isn't it?
And I think there's one in December also.
Okay. It'll have to be late in December.
Yeah. And last I saw for the next meeting, 75 basis points had about a 75% probability.
Yeah. There you go.
Based on the CBOE.
Yep.
Yeah.
Yep. So so that's an incredibly fast rate, and allegedly that's happening along with, and I think Jerome Powell even tried to put a number to it. He's claimed that the rate at which they were delevering their balance sheet would be the equivalent of adding another 100 basis points to the rate increases. That's what I seem to remember him saying. Quantitative tightening, as it's known.
Right. Yeah, but their balance sheet runoff. We were talking about this before we started the podcast here. Their balance sheet runoff has been largely a joke. It's barely moved.
Yep, no question. So for those of you who are listening to the podcast rather than viewing, we'll try to explain where we're headed next. We're going to take a look at the Chaikin Analytics platform, and we're going to look at a watch list that we have, which essentially shows us all the core macroeconomic ETFs from around the world. Now, one of the differences between Chaikin Analytics and the cheat sheet system, for example, that I curate, is that we get a proprietary fundamental measurement. Now, outside of the U.S., there is no fundamental component to this. So when I'm talking about emerging markets or China, for example, we'll get basically what's referred to as a power gauge number for completely based on technicals. But for the U.S.-based ETFs, we're going to be able to take a look at the fundamentals to go along with things, because there's some interesting stuff happening. AA, like one of the things that perplexes me is why consumer, not discretionary, but consumer staples is falling out of bed, and is utilities. I think that one's more easily explained. But the defensive stuff is either just catching up to the rest of the market, or we're seeing some kind of bizarre rotation into growth. And I can't quite put my finger on what's causing it, but it's definitely happening.
It is. I've noticed it also, and I'll just add real quick. When we look at these international and macroeconomic ETFs, price is a news story in itself, right? So just the price of these things is information, and how they're trading is macro information.
Yeah. Yep, that's a good point. So I think that obviously what's on top of the list is the most important thing. The thing that drives the relative value of everything else is the strength of the world's reserve currency, the dollar, which I'm expressing as UUP, the ETF. It basically tracks the dollar against a basket of G7 economy currencies. And lower left, upper right, as far as the trajectory of the dollar goes, recently a little bit of a pullback, and money flow hasn't fully recovered yet. So, there's a chance here the dollar ends up going sideways and gives other other central banks the opportunity to raise rates if they want to try to catch up with the U.S. The problem is they're not all opting to raise rates. Japan, I still think, has negative rates. ECB, I have lost track of. I remember they actually moved out of negative rates in July over the summer, but I've lost track of what they've done since then. But the euro has strengthened versus the dollar. It's gotten a little bit better. It's not stronger then, but a little bit better. You wouldn't happen to know what the ECB has been up to, do you?
I think that they've implemented a few hikes, and I don't want to say for sure. I think that they're back into negative territory barely.
Yeah, it makes sense
somehow.
One of the things we pay attention to on the analytics platform is something you can actually construct in your charts at home by creating a stochastic RSI. That's essentially a 21-day overbought, oversold oscillator. So it's basically a stochastic of the relative strength index. And what it does is does a pretty good job of catching the major intermediate pivots in the market. And I would say the Chaikin oscillator after the Chaikin power gauge are two of the most valuable tools that the software offers us.
Just real quick, Mike, I want to go back to something you said about Japan not raising rates, and you're absolutely right. But what they're doing and what may become a little more widespread, I'm not sure, but Japan has done it is they've done currency intervention, right? So they've sold dollars to buy yen to support their own currency.
That's
so
right.
so while they're not raising rates, they are taking action to support the yen.
And the Bank of England is doing the same thing.
Exactly. Yeah.
Yep. So we do have a little bit of a divergence where we see a lower high in the momentum oscillator recently against the dollar, while the dollar put in a higher high. And of course, since that happened, the dollar's pulled back now, and I think is in danger of actually fulfilling the potential that oscillator said, which is a lower high, which means we're coiling up like a spring, not necessarily a reversal pattern, but possibly a little bit of a sideways pattern there, but no money flow. That leads me to believe we're not going to break out above that 30.50 mark, which is on the UUP. Dollar ETF. Now, some other economic bellwethers would include TLT, which is essentially the 20-year Treasury bond, and that's in free fall. Some weird oscillator divergences there too, though.
Yeah, the price action on bonds in general is a little strange. Somebody was buying something on Friday because amidst what was it, a 3% down day or 2.5% down day on the indices. On a relative basis, bonds held up pretty well on a pretty severe down day. 10 years heading back, I think, to retest that previous high set last week or maybe the week before, that 3.99 on the 10-year.
Yeah, let me go over here. Just bear with me. We're using the TNX to show the yield on the 10-year Treasury note. And for those of you who are not able to watch on a screen, as of Sunday afternoon, interest rates stand at roughly 3.88, 3.89, so near that 4% peak that we got about 10 trading days ago.
So I think, and again, I think this is a question that's going to be answered later in the week when CPI hits. Is are we going to set a lower high, or are we going to break through that 3.99 and set a higher high?
It would seem to me that in the same way that nobody's going to admit to the U.S. tampering with the Nord Stream pipeline, I think the idea of stealth bond buying here at the lows is probably a necessary evil. Because let's face it, the government can't afford the carrying costs much above 4% interest rates.
Yeah, at this rate, I read this week, actually I read this last week, at this rate, the debt with these interest levels will make it the single largest line item in the U.S. budget beyond military expense.
And all we got left is military and or entitlements, both of which would be a third rail here. So when you just kind of think this through, the idea of whether it's 7 or 11 guys, whatever the voting constituency of the Fed is, it's very clear to me that they're going to have to manipulate the markets almost in perpetuity for us to get through it, especially with the number of retirees liquidating assets. It just feels like we're in a box. The only way out of it would be some type of breakthrough growth. Somebody needs to snap their fingers and solve climate change, battery storage, new sources of petroleum that can be pulled out of the ground that doesn't hurt the climate. We did have maybe that equivalent in pharma, and you'll see how well rewarded pharma at least starting to get bouncing off a bottom. It had a little bit of a spike on news about Eli Lilly's obesity drug and about the Alzheimer's drug that came out of phase 2 trials and into phase 3 with encouraging data. And while we're not seeing yet incredibly good price action on pharma yet, we both noted the relative strength is kicking up. And that's always the first sign, right? We go down less than a falling market. And then eventually we start going up from there. So I've got my eyes on pharma, especially because we are likely doing a light volume retest of the bottom. You'll notice that the 2 up days that we had recently were huge volume AA, and the down days have been nothing, leading me to believe that a nice soft landing creates a double bottom opportunity for pharma, or you could just go right after it with the parent company, which is trading right now at resistance, with the possibility of breaking out here. Maybe earnings will be that catalyst.
Yeah, we are getting into earnings season, so you have to be conscious of that with whatever you're doing.
Very quickly, we'll just review some of the other commodities. And again, the FXE, the euro, looks very similar. It looks like maybe the damage has been mitigated, meaning maybe it's not going to go down as much anymore. We are seeing, again, we saw a lower low in price, but a higher low in the oscillator. And now we basically, after that divergence, hit our head on a downtrending moving average and are looking to put in an actual higher low. And that might solve the euro crash. And then commodities are starting to pick up steam. We talked about this at the outset. We saw it on, for those of you who subscribe to stockcheatsheets.substack.com, notice that commodities and energy in particular were starting to outperform. And we're definitely seeing that in price. The DBC seems to be trying to put in a double bottom. Once again, another oscillator divergence AA, where recently the DBC put in a lower low, but a higher low in price. Of course, that oscillator is not exactly fully intuitive because it's more coiled up into a triangle and broke out of that. So, but it looks good. The momentum looks positive on DBC.
Yeah.
Precious metals, on the other hand, we've broken to a new momentum high. We've broken our downtrend, and I guess we put in a similar high on price, but the money flow is just not there, and I'm not feeling gold or silver as much as I thought I might. Silver's a little better. Of course, it's got some industrial metal applications, but and we did have a new higher low in silver and a breakout above a recent high. So a little bit better for silver than gold.
Precious metal is the child you thought had potential and just didn't do anything.
Yep.
It's very disappointing.
Meanwhile, the big story is oil. And you had mentioned, something funny going on in the bond market on Friday. If you look at oil, and I'm going to actually, for those of you watching, I'm going to dial up the futures contract for oil so we can look at the volume. But there was a big move in oil on Friday, and it was accompanied by a much higher than average volume. And this was well after the Saudi Arabia announced the OPEC production cut. And I think there was some lend-lease stuff. The Department of Interior was supposed to release a report about what kind of drilling space it was going to allow. And there was some concern that there would be a blanket freeze on all drilling rights around the United States. Didn't matter what part of what coast you were on, including the Gulf of Mexico. That didn't happen. And I'm wondering if that's the news, but something's up in the energy market. We got another big pop on volume on Friday that I can't completely explain.
I don't have any ideas either. I'm in an oil trade and I'm enjoying the move, but I don't have any ideas what's going on there. It does look, though, just looking at the technicals here, break through this 95 level, 100 could happen pretty quickly. Would you agree?
Yep, off to the races. So I'm holding some energy myself and watching it like a hawk. I'm actually rolling puts on XLE, which of course is the way for those of you who are newer to trading and aren't involved in futures yet. Before you consider a commodity-based ETF, I strongly recommend getting educated about companies that will benefit from underlying commodity price increases or decreases as your catalyst, rather than necessarily trading an ETF that's tied to a commodity. We've talked enough about why. I won't get into it again.
Okay.
But again, AA, if you notice that XLE busted through diagonal resistance on an intermediate basis, and one of my favorite signals that is, I think, setting up would be a valley peak valley reversal. And that's where we move up to a higher high after putting in our low. And then we pull back with light volume and bounce. And so that higher low creates that VPV reversal pattern, which usually ends up being nicely rewarding if you have the patience for it.
Did the I'm just looking here right here. Did the volume on, say, XLE or XOP kind of correlate with the volume in crude? Not a bad day, but not an outsized day.
Correct. It was all about crude, and that's what I'm trying to figure out is what catalyzed the move. It also happened, I think, kind of late in the trading day. Let's take a look at the 5-minute bars because I am curious about that. Yeah, see, it popped. It was just before Like, what does somebody know? Oh, I guess, no, you know what? I'm sorry. It started right around 8 o'clock. So I guess it was tied to the jobs report I guess we must have surprised to the upside.
The jobs report was stronger than
Yep.
definitely the Fed would have liked to have seen. That's for sure.
Yeah. So more jobs mean more economic activity. That probably surprised the market. The price of oil might have been discounted especially in light of the production cuts. The demand for oil, nationwide might increase our thirst by a certain percentage, and we don't have the resources to accommodate that thirst without, going out to foreign markets to buy it. Believe it or not.
Yeah,
it's a little frustrating. Back to Chaikin we go. Just checking to see what the most bearish U.S. fundamental stocks are, and I'm going to transition to our sector and subsector. Maybe you can help me if you see the subsector ETFs or the sector ETFs. I wanted to go there first.
I am not seeing it.
Yeah, I'm not seeing it either, which would be weird because they've been there for years. There it is, sectors. Okay. So let's talk about what's bearish first. What's interesting is what's bearish might be what's doing best from a relative strength standpoint, and that's XLB.
Which is basic materials, of course.
Yep, XLB Natural Resources 0 to 10 on the power gauge. So there's nothing fundamentally strong about these. Price is actually trading near the lows, but the recent price action is apparently better than the market. We also have one of those oscillators again where I guess we put in a slightly better low. I don't know if that's really the case though.
Yeah.
XLB looks pretty dead in the water to me, and I'm not nearly as excited about it as I was looking at the relative strength charts.
Yeah.
XLRE, boy, the bottom has really fallen out. And I think you have some first-party evidence that suggests that this is pretty sustainable. Why don't you tell people what you do when you're not trading or working as a broadcast professional?
Oh yeah, so I'm involved in the mortgage industry, and things are slow, to say the least. Although I'm also involved in a sale just personally here in Denver. And that property went under contract in 3 days at full price. So there's still demand for properties at a certain price point, despite the fact that mortgages are now over 7%, which they haven't been since well before the GFC. So it's just an interesting market, and I think Jerome Powell has said that housing needs a reset, and it's in process, it seems.
We also have an explosion in Americans' use of credit at a time where banks are starting to tighten lending standards, worried about defaults. So we do have kind of a perfect storm of assets getting more expensive, money harder to borrow. It's more expensive to borrow. There's plenty of jobs out there. Let's face it, the open positions only went down, about 10%? The last jobs report from 11 million down to only 10 million or something like that. Of course, some of that is bullshit, right? There was some smoke and mirror job openings that really aren't. But all in all, the real estate market looks terrible. XLRE is in a massive downtrend. It tried to throw back and retest an earlier broken support at around 39. It maybe made it back to 37 and a half.
Yeah, maybe. Real estate is just it's just an ugly place to be right now.
Yeah. Before rolling over, this is one of kind of AA's favorite short setups, though it's probably a little bit a day too late here, where the oscillator is rolled over. Price produced what we call a bear flag pattern. Yeah. And I'd still say if there's a slight throwback, a retest tomorrow, or if the market just decides to open on hopium a little bit, I could see trying to throw on a bear call spread on real estate at even I'd even do it at the 37, 39 bear call spread looks pretty attractive to me.
If it gets back a little bit higher, huh?
Yeah, I'd like to get it up a little higher. So maybe I could it'd be nice to be able to put my goalposts up as high as 40 if I could.
Yeah. Okay.
Yep.
Okay.
So as far as bearish, communications, which is really kind of a weird ETF, that's Facebook and Google, along with Verizon and Time Warner, or whatever they're called now, Spectrum.
Right. It's a strange mix of growth and yield, right?
But zero bullish stocks.
Yeah.
So it is, the chart looks just like XLRE. And so that's our tier. We have basic materials. This is from a fundamental standpoint, but we've now just confirmed, for those of you watching, I don't think there's any bullish technicals anywhere to be found in any of that stuff. So then we have a whole bunch of neutral stuff and only one bullish stock. It's actually very bullish. That's energy. and energy is basically a sideways trade that would still need to get up to 90 before it would break out. Money flow is still not that great, and relative strength just got started. The oscillator is nearly over bought, and the fundamental score is actually very good at 11 bullish or very bullish stocks and 0 bearish or very bearish. So, but not yet necessarily tradable.
It actually appears to have some momentum behind it, but it also has some speed bumps ahead of it. You know,
now you and I got in down here where it made some sense, right?
Yeah.
We're playing for I mean, this has been nicely rewarding. I think I told you I rolled my put up, and you can see why. And you thought you were in a diagonal that was totally blown up. That you probably didn't even look at that this day, and you probably thought you were done and went to worthless, and you were shocked when you opened your trading account up after taking a few days off.
Yeah, the last week, my worthless trade came back and is in the money now, so it was nice to see.
Let's quickly circle back to the 3 major indexes. I want to start with DIA because that one of all of them has the most to lose based on dollar strength. And so as a result, we had a slight, I guess, weakening of a bad trend, strengthening of a bad trend is probably a better way of saying it. But we're right back to where we started from, and multinationals appear to have breached, right? We've got 2 gaps that sort of line up with a mid-June low. And so to me, I think we have a couple of island reversals, but to me, this has got the potential to act as new resistance. How about you?
Yeah, nothing looks bullish here to me. Nothing looks bullish.
Yeah, 7 bearish to very bearish stocks, 0 bullish, 23 neutral. Money flow is negative. The long-term trend line of the DIA is pointing lower. There is some relative strength versus the SPY. But big deal. It just means you're going down a little less than the SPY. Neutral rating on the power gauge, bearish only for me on that one. And then we have small caps, which they're actually the best looking U.S. index.
They are
not, which is an interesting tell to me.
That says something. Exactly.
It really does.
Mm-hmm.
Yep. We have I think a very well tested bottom, and it will take, I think, some work to breach this. Now, God forbid, between Putin and Biden, they have enough. They don't even have to press that button. All they do is talk about it, and this will break the 160 level on IWM. But God forbid that doesn't happen. Geopolitical concerns notwithstanding, it just feels to me like between money flow, certainly the fundamentals aren't there, but they're not horrible. 263 to 497. I would have expected, based on how long we're into a bear market, I would have expected something like a 50 or 100 to 450 or 500 kind of ratio. So not as bad. Certainly nothing to write home about.
And for those listening, that ratio is stocks rated bullish or very bullish to bearish or very bearish by the Chaikin Analytics metrics. Yeah.
And we're slightly better than 0.5, I'd say.
Yeah. Yeah.
Yep.
No, I've been watching IWM this weekend. It has held up better, and it's an encouraging sign. 100%. Absolutely.
Some kind of neutral trade that gives you a little bit of downside protection. For those of you who don't like advanced option strategies, this is where you can consider a covered call where you actually put your short strike in the money at around, I just have to see what the premium pays. But one idea I have left from the last bear market I traded, where I was a little uncomfortable going short, is if you believe that support line at around 163 can hold, the market is trading at 168 now, something like that. Yeah, 168.61.
Yeah.
If you could sell a call that would pay you 3 or 4% and cover the difference between the current price and the strike price. So you need about $11 in premium per share to make this work. That is a trade that once a bottom has been tested in the market, even if we're likely to leg down to a new low, the chances of support holding between now and your expiration are really pretty high when it comes to a well-tested bottom. And while it's certainly a stock you would have to watch closely and bail on the minute the 160 level would be breached, I know a lot of traders that did very well in the bear market of 2008, selling in the money covered calls that had enough extra premium left over to pay them what a normal covered call would in 12 VIX days. So just one idea to think about.
Another idea, something I've been dabbling with a little bit the last few weeks, given the strength in the IWM, is pairs trading futures. So IWM, in my case, what I was doing, and not a recommendation, is long Russell, short NASDAQ, and pair those off in a way to manage the deltas how you see appropriate. But that's one way I approached it also.
And for those that aren't approved for futures trading, you can do it with shares of stock, and it wouldn't be horrible to do. You can figure out what the ratio is between two different indexes, one of which you favor more than the other. In this case, what AA I think would be suggesting is pairs trading the IWM versus the Qs, for example, where I think the Qs are a lot weaker. And you could balance the shares off, and it's the difference in performance where the IWM holds and the Qs don't. You're short the Qs and long the IWM, and you make a little money on that spread, but you're not putting a whole bunch of money at risk. It's just the difference between the two ETFs that become the problem if you can balance everything out.
Exactly.
What do you think of SPY here? We've got, first of all, fundamental rating, about what I'd expect for a horrific bear market lasting as long, and certainly much worse than the Russell, 40 to 118 in terms of bullish or very bullish stocks compared to bearish. A neutral overall rating. I think that technicals may be driving that neutral rating. A fairly well-tested bottom, but something makes me feel less good about SPY than IWM. I guess money flow would be one reason, relative strength another.
I'm going to take a quick left turn on you, Mike, and I'm sorry, but the thing about SPY is I'm looking at Apple and I'm looking at Google and I'm looking at these major components, and they're what make me feel less rosy about SPY.
Yep, good point. And of course, Apple is definitely in a downtrend. Actually, it looks like Friday was an entry signal. If you like, there's a couple of things that concern me. Obviously, earnings is one. We also have a divergence in the oscillator, kind of a weird divergence, right? It's a double divergence. Where we're coiling up like a spring. It's more like a triangle. So I don't think this is quite a reversal divergence, but we do have a slightly higher low, while Apple makes a lower low in price. But for those bearish, there's a setup here. You could trade an out of the money call spread, sell the 150, 155, provided you can make enough money, and you get paid as long as price of that call spread or the price of the market stays lower than the short strike for the time we have left till November 18th. And that would be probably how I would trade this, knowing that I think there's a good chance of Apple testing 130 before it's done going down, maybe 135.
Yeah, let me ask you this. Of course, there's no crystal ball. What happens first, 135 or 150?
Yeah, and we are our momentum oscillator is rolling up off of a higher low. Price is not going that way. So I would tend to take the bear flag entry myself, just because a trend. It doesn't end until it does, and I would take the third leg lower. First of all, I think this is such a hypothetical. Apple has earnings between now and expiration. I don't think either one of us would touch it.
No, you're right. You're right.
Maybe a risk-defined trade, but you got a 50-50 on it, not a 70-30 the way you normally would with a spread.
But these are the things I'm looking at when I look at the SPY. Google's another one, Amazon's another one, and these things are making me have a little less conviction about a sustained bottom quite yet.
So XLU is probably the best example of a security where I need to look under the hood and understand the fundamentals of the underlying stocks to figure out why we're crashing. Our theory is that XLU pays a yield that unfortunately no longer is attractive relative to the yield on bonds. The yield on bonds is what, about 3.5% right now on the 10-year?
10-year, yeah. It's nearly 4 again.
Yep. So here's the problem. The dividend yield on XLU, even after this collapse, is only 3.1%.
Yeah.
So you do the math. Do you want to trade on the dividend yield that's offering 3.12% with risk, or the virtually risk-free,
right,
to the extent that any government bond is risk-free these days, where you're getting closer to 4% yield, hence the collapse?
Yeah. The risk-free, quote unquote, risk-free is the key to that, I think.
Yep.
Yeah.
Yep. So here we go. There's definitely a break in overall trend, really a collapse. And I think as long as interest rates stay higher, XLU is a trade I would avoid bullishly in perpetuity. I'd be careful about.
I would avoid that one also. And then personally, I shy away from trading anything in XLU bearishly because of the yield.
Yep. So the other thing that I would I'm interested in looking in, because we definitely had a major support break, and I'm just checking the 5-year chart to see if there's anything that's going to save us here. And I would say we have a massive head and shoulders breach here on XLP, and I'm starting to think a long put diagonal might be an appropriate trade now.
I can't see, it's a little small on my screen. Did we get the throwback to the neckline yet?
Not yet. Here, I'll put it up on here. I'm just saying that's why I'm thinking the setup is going to be interesting here.
Yeah.
Waiting for that opportunity after the retest. Although we may have gotten it. So let me take us out to the 1 year. Yeah, I think we did get it.
Oh, I guess we did. Yep.
And, so there's this is the head and shoulders. It's a little more clearly defined on the weekly bars, which I can't replicate here without AA not being able to see the pattern. So we broke, and then we threw back and retested, and we could. I'll do this maybe in the weekly bars as a compromise.
Could you maybe call out that neckline to the audio listeners?
Yes.
I can't quite see it.
Yep. So thank you. The head and shoulders that I've identified is it's not a perfectly formed one. And you who are studying for your certified market technician's license would probably have a problem with the fact that this touch didn't happen, right? Because technical patterns need to happen. But I would argue that maybe this is the head and shoulders. Well, it's not yet.
Not yet.
But I'm looking at this as a potential reversal pattern where you have shoulder, head, shoulder, breach, retest back to the neckline, and now I'll get into it. So we're talking about a 68.72 neckline and an $80. Let's make this really simple. Let's call it a $70 neckline and an $80, maybe a $69 neckline and an $80 head. So an $11 difference between the top of the head and the shoulder and the neckline.
And I'll say whatever the pattern is, it's clearly, I mean, there's clearly a well-defined neckline and a rounding top pattern.
Yeah, if you don't like it as if you don't like it as a head and shoulders, take it as a descending triangle, then it's a perfectly formed pattern. Yep. So we would measure $11 from 69 and get a price target that's going to be, roughly speaking, $58, right?
Yeah.
So let's see where that puts us here. And what we're doing is we're measuring the distance between that top of the head at 80-ish and 69, the lower, and we're adding $11 to that and trying to use a long enough time frame to get that number. And it would put us down, what did I say, 58, 59?
58 is what you said, yeah.
Okay. So look at that, right to this congestion area here.
Yeah, it's amazing how that works.
Yeah, it's amazing how that works. And the other thing you can do is use, and I'm sorry, folks at home, you're just going to have to live through the irrelevance. The other thing you can do is a Fibonacci extension. I need to go top to bottom, don't I?
Yeah, I believe so.
I can't remember. It's been so long. Nope. Actually, I had it right the first time. So I'll be conservative. Take it to the top of well, actually on a daily candle, it's going to be here. Let's use that. Not perfectly measured, but the price target that we'd look to is pretty well lines up with this first congestion area, the 150, and then we have the 161, which kind of perfectly lines up with this. So this would probably be our price target here.
So basically, the price target you're describing takes us back to where we were in sometime in 2020, just after the onset of the pandemic. Yep.
So the conservative way to trade this would be, provided we inch back up a little bit tomorrow, as we'd look to trade the 69.71 or 70.72 call spread. And if we did that, I'll just try to see if there's any hay we can make out of that. I would come out to, I think we're still okay for November, don't you?
Yeah, I do.
So we'll look at November. Oh, look at, here I am already in the market with a trade, like I'm talking about. But we'd probably do the 69 at this point, and hopefully we could get back to the 70 with a little bit of a move higher in the market.
Got it.
Right. Ooh, we got the house burning down there.
Yeah, sorry.
As long as it's not yours. That's
not my house. No.
Yeah. Oh boy, your volume you just turned into the voice of God.
Oh, sorry.
Yeah, no, it's all right. AA does voiceover, as you can probably tell. So look at the premium, 73 cents for a $2 wide at a 33 delta. That's pretty good.
It's pretty good. Yeah.
Yep. And AA and I think an acceptable trade is 50 cents. Now or 50 cents or higher for a $2 wide call spread. Now remember, the way this works is that you're paid an instant credit of $73 or 73 cents a share. 100 shares in a contract. And what we're doing is going short 69. And then we protect ourselves in case XLP decides to keep going up. We protect ourselves at 71. So our exposure in terms of risk becomes the difference between the strike price we sell of 69 right here and 71, the price we buy. So if the stock moves up to above 71 between now and expiration, we're only responsible for that portion covered by our spread. As long as we stay underneath 69 between now and actually it's 69 and 71 cents, 69.71, we'll make a penny or more on the trade. And then below 70, or excuse me, below 69, we'd keep our entire $73 credit times the number of contracts that we decide to sell. So that'd be a conservative trade. And the way we decide whether or not that conservative trade is worth it is if we get paid better than our risk. So if we know our hypothetical probability of breaking even or better is, and I'm going to need you on shotgun on the calculator if you don't
Got
mind.
it. Yeah.
Is 27, we'll call it 28%. Okay. So we need to get paid better than 28% in order to justify taking the risk. And that's how casinos make their living, right? Because casinos don't win every hand at the blackjack table or every pull at the slot machine. They, in fact, pay a fairly big number of gamblers out. The key is they have lots of occurrences. And when they do pay out, they tend to pay less than what they pay out on a percentage basis is less than the risk they incur. And as long as they do that over and over and over again, which is what you would have to do as a trader committed to this strategy, as long as you get paid better than the risk you take, you will be a winner. And my guess is I'm going to say AA, this is going to be a trade for the ages just based on that 71 cents if we can really get filled at that.
Yeah.
Because my guess is the reward on risk is a lot better than 27%.
It is. It's 57.
Which is probably as good as we ever see.
It is. Now, of course, markets are closed, so that 73 might turn
market
into
makers probably
65 by the time the market opens. Who knows? But
Yep.
Based on the numbers we have in front of us, yeah.
Yep. So listen, even though the bid-ask spread is probably widened out and it's probably a lot tighter than that, my hypothesis is that would be a trade. Now, unfortunately, the most you could make, and we'll just pretend you have a $100,000 account, okay, and you don't want to risk more than 1% of your trading account, maybe 2% for this strategy, just because it tends to win, 8 or 9 times out of 10.
High probability.
Yeah, high probability. But you have to calculate the risk. So if you're getting paid, we'll call it 70 cents. If you're going to get paid 70 cents, it means you're risking $1.30. So you take whatever the number is in terms of the amount you can afford to risk per trade and divide it by that credit. So if it's $1,000, each contract, remember, is 100 times whatever your credit is. So it would be $73 divided into 1,000. My guess is we get roughly 12 contracts. And then AA, you can help me.
What
that
is
number?
100 and actually I got less than that. I got 8.
Yeah, and I just did it off the top of my head. So.
Okay.
And I am now sizing up the cheat sheet way, which is if you want to go over by $16, you can afford to carry 8 contracts. If you want to be strict about staying under $1,000, carry 7. So 7 times 73 is pretty good, $500-600, something like that, right? 500-ish.
7 times 73 is 511.
511 is your reward. 511 exactly is your reward. 889 is your risk. And if your odds of success are 30%, or your risk against losing, then it's a very good trade.
Yeah.
And so that's why and how we can make money in an elevated volatility market. Of course, what AA is probably thinking, being the perma bear that he is, you're leaving some money off the table here. This is these type of short opportunities don't come around, but maybe once a decade. And you'd probably do something a little different, like probably not a naked long put, but my guess is you'd step up to the plate with a put diagonal on this one.
Yep, that's probably exactly what I would do, which would just be, buying one put far dated at the money, basically, and then selling another put nearer dated out of money.
Probably do the 69 again as our sold. We'd probably do the 64, right, as our sold put.
Yeah.
If you can remember that, I'll go out to January. That's a popular month to buy. And what we want to do is we want to start in the money a little bit. Not a whole lot of open interest here, Double A.
Other side,
Surprisingly.
put side.
Sorry. Thank you. Lots of open interest on the put side.
Yep.
Well, we want to do in the money. We'll do, how about the 68 Delta 1,000 contracts?
Yeah.
So we'll pay, when again, look at the market maker has widened this out. So assuming that this bid-ask spread comes in and the midpoint in between these is actually a fair market price, we'll make that assumption for demonstration purposes. But you never want to trade anything that has a 50% difference in the bid-ask spread.
Yeah.
So we're going to buy a diagonal. And maybe you could explain how this is really kind of like a covered call on steroids while I set it up.
Yeah. So basically, because the owned put, the put you're long is far out in time and is at a number higher than the put that you're selling. Basically, the difference between the two is not only is the difference between the two yours, should the trade go your way, but you can keep rolling that short put out in time and collecting premium along the way.
Yeah, and it looks just like a covered call trade when you do it on paper, although this would be a covered, I guess a covered short. If you were short the stock.
Yeah.
And if you basically, if you borrowed the stock to short it and then you overrode it with a sold put to protect yourself, or a bought put, I guess, in that case. It gets confusing when you have to reverse everything.
Right.
Yeah, I'd make sure I'm doing this right. You'd short the stock and then buy an out of the money put further out of the money, I think, right? That's
yeah.
Yeah.
But that's pretty capital intensive.
Yeah, something I don't do very often, ever. I will do some covered calls occasionally when you can't really get the options to work out, because a lot of times, liquidity is an issue for long dated options, and so it's better to buy the stock.
Yeah.
But it is capital intensive. This is not. So this is what it looks like. Is I'm basically saying that I think the stock is going down, and what I'd like to do is lower my cost basis a little bit by selling an out of the money put at around the 30 delta. And all that simply means is that what I want to do is make a little bit of premium off of an out of the money put to lower my cost basis. An out of the money put, I think, that doesn't have a very good chance of causing me to have to act on my short put, essentially.
Yeah.
And so what we do is when we add up the cost to go long the in the money 71 January long dated in the money put, and we offset the cost by selling a short dated out of the money put. Remember, we did the 64, and that's $397. Here's what it looks like on the charts. Is we're the equivalent of short the stock, but what did I say? It was 64, right?
Yeah.
So basically, I get to keep everything that happens between where we're at right now and 64. So this couple $3. That's all mine, plus the premium that I collect, which is another couple $100. That's all mine, and it provided that price comes down and then perhaps jumps back up and retest this neckline. What I'd like to do is buy back that put or roll it to the next month and try to keep the premium coming in while I trade the stock to the downside. I honestly, Double A, don't have much luck beyond one roll, maybe occasionally 3 rolls or 2 rolls. Have you ever gotten to 3 rolls consistently, except when you're, protecting yourself by rolling a strangle where you kind of have to roll it to survive? I don't find myself doing really well beyond 2 rolls.
You're right. I agree. I agree
Yep.
with that. Yeah.
So the realistic, people always talk about you do that every month and look at you can make a 50% return on your money with very little risk. Well, the reality is that whether you're doing the covered call strategy called a in the money call diagonal or the in the money put diagonal, you're basically usually rolling once, maybe twice, collecting the capital difference and the premium. And so that results in a trade that takes you from $400 worth of capital outlay to a reward that's nearly $300. So let's call it a 75% return on risk. And your actual probabilities, assuming that these prices are right, and they're not, you have slightly better than a 50-50 going on. You've got about a 60% chance of making a 75% return. Now, my guess is that when the market opens, those numbers will be tighter, but once again, a pretty good pot odds. And I think you'd agree with me, Double A. If you had a gun to your head and had to bet, what direction are you predicting for XLP?
Momentum's a hell of a thing. So
Yep.
I would go with the current direction of momentum.
Yep. And since the market wants to extract as many dollars out of AA and the rest of us as often as possible, it will do something to shake us out of the trade as a weak hand, and then and then proceed to follow in the direction that AA originally forecast. Because that's what markets do.
That's
when there's
exactly.
a consensus of opinion that's in high agreement, the market does something else.
Which, to take it full circle, is why I agree with you in your assessment at the very start of this call that the market probably isn't going to hit a free fall moment in the next couple of days, is because that's what everybody's expecting.
Yep. Let's go through very quickly to wrap this up. We talked a little bit about the economic reports that are to come. And I do have to cover some cheat sheets. So premium subscribers, don't hang up. We've got a little bit more work to do. But for those of you who don't subscribe to cheat sheets or Macro Monkeys, probably there will be a bit of a macro discussion involved in cheat sheets. But it may be visually there won't be a whole lot of visual descriptive language to go along with it. Would that be fair?
Yeah.
Yeah. So thank you, Macro Monkeys listeners. Thank you, Chaikin Power users. Before you go, let's just go through the data that we've got ahead of us. Monday is Columbus Day, but we do have some Fed talking heads.
Yeah, and the bond market's closed on Monday. I have just learned.
Yep, stocks are trading, but there's no key economic reports due on Monday. And then Tuesday we get some a New York Fed inflation extrapolation that tends to not be market moving. And more Fed head speak. And then Wednesday, we get the forward-looking index. It's sort of like, how would you describe PPI, AA? Maybe a forward-looking version of the CPI?
Yeah, I don't know that I have a way to articulate it.
It's basically what the wholesalers pay. So it's basically the wholesaler inflation index.
Okay, that makes sense. Yeah.
So if you resell widgets, the Thursday CPI is what kind of year-over-year price increases the consumers pay for widgets. This is simply the producer price index, so it's more forward-looking, right? It's earlier in the chain, and it can be like if inflation is going to get busted, it'll start because sales have dropped, and manufacturers and widget makers have to lower prices to make sure that they're in line with their competition, right? As far as demand goes.
Call it input costs, maybe.
Input costs is a great way of saying it. Yep. Cool. So you have that and labor costs, and that defines the markets. So then Thursday, we turn our attention to consumers, and that's going to be more of a lagging indicator. We're looking back as opposed to, basically what prices producers are willing to pay in anticipation of demand. They have to build inventory and make a guess about, well, of course, they're all going to want to try to get away with the lowest prices possible, but the market ultimately decides. And consumers, they have the same kind of pricing power, but it takes longer to correct. And so we'll be looking at those inflation numbers, which we've gone into, core and regular. And then we also get jobless claims. Consensus estimate is that we'll be down maybe 4,000 jobless claims. So actually, forecasters are expecting an even better jobless claim number. So unemployment, at least so far, hasn't started to rear its ugly head, but we'd probably start to see it in this number before anywhere else, right?
Yeah, and the other number to watch is JOLTS, right? Which is openings, which is Fed. The Fed, I know, or at least I believe the Fed is watching that pretty closely.
And I think Friday has the potential to be market moving. Retail sales typically moves the XLY and the XRT ETFs, but is very rarely market moving. But I think this could be different in that if retail sales slow surprisingly, the market will, I think, take that as good news that the Fed's rate hikes are starting to have some impact in the real economy. And I think the market will celebrate that once again under this idea that this will make the Fed pivot a little bit shorter term horizon. I'm not saying that's whatever actually happened in reality. I just think that's the way market participants might take a weaker than expected retail sales number.
Bad news has become good news.
That's what I think. I mean, you think I'm off base?
No, I don't.
Yeah. And then the other one, which is really harder to predict because the consumer sentiment survey actually happens in 2 or 3 different parts. But generally speaking, the first of the estimates for the month is the one that's more market moving. And that's what we're going to get at 10 o'clock Eastern time on Friday when we get the University of Michigan Consumer Sentiment Price Index. And double A, I'm not sure about that one. I think if we got a shocking number where consumer sentiment is just dropping through the floor, I just don't know if that's a good news is bad news scenario, or vice versa. I guess bad news is good news.
Yeah, I don't either, because what consumers say and what they feel is different than what they're doing, and what they're doing is ultimately more important. But also, it's worth noting with the UMich survey that it's basically a discussion about gasoline prices. That is largely what the UMich survey reflects.
But when there is a huge, and I would say this one does get market moving, when there's a huge unexpected either drop or explosion in that number. Now, usually they need another month to take it seriously, but it does get noticed. And I would say that if we get that explosively worse number, market participants might not go, woohoo, the Fed's going to ease soon. That might not happen at all, because they could speak to a deeper, more sustained and more broad-based recession. And so I just wonder, I don't think we're potty trained on that one number enough to be able to forecast market reaction yet, in my opinion, at least for this cycle.
I agree.
I think inventories is another interesting one, because listen, if inventories show a bigger build than is expected going into the holiday season, that might be a bad news is good news situation. The idea is that producers are already stuck with too much Q3 junk on their, on their shelves that they have to dump. It means there'll be a lot of holiday discounts. There'll be toilet training. Sorry to use the bathroom metaphor again. Consumers on lower prices earlier in the holiday shopping season. That doesn't bode well for any of the holiday shopping numbers, but that might actually be a good thing as far as the market is concerned, vis-a-vis the Fed.
I agree with that. Also, have you noticed, and maybe I don't mean to jump around too much. Have you noticed the shipping rates recently they've imploded, basically?
Yes.
The cost of shipping goods overseas is a fraction of what it was just a few months ago.
I watched a video from one of the, there's a couple of YouTubers. They all have to use really gloom and doom headlines to get clicks. It's probably why you and I never got any clicks. All of those years of doing Chaikin reports, had I written more sensational headlines, we'd probably be retired in Bermuda doing our Chaikin analytics updates.
Opportunity missed.
Yeah, and here we are, radio people who are used to doing tricks like that to get audience. We didn't do it for ourselves. But anyway, so a YouTuber definitely does a lot of that. He's the Bond. Have you ever watched the Bond King? YouTube videos?
Yeah, I have.
Markets are crashing.
Yeah.
He's like if Ted Knight covered stocks, or Ted Baxter on the Mary Tyler Moore Show, not to date me. But anyway, so he covered the number of ships that are in the queue from China in the Pacific shipping lanes right now, kind of waiting to unload. And he claims that, and he's very much a numbers guy, so he tracks the numbers. And if your portfolio needs protection, I'll put the link up on the screen here. You know the guy I'm talking about.
I do.
He's upselling the plunge protection.
Yeah.
Basically, that's what they're selling when they give you all this data. And so, of course, they're cherry picking the worst news possible to get you in a panic that your retirement savings is going to get wiped out. But if I could get to my point, and I'm the only one blocking myself from my own point, from 43 ships to 9 ships in line from China.
Yeah.
Right now. So again, just to keep the theme, and I won't go any further than a week from Monday, the Empire State Manufacturing Index, that's actually a big one too, because that speaks to factory orders, meaning what widgets are you going to produce? This is actually not just buying inventory, it's actually buying production of inventory. So it's probably the leadingest indicator that we've got.
Right. And that's a week from Monday.
Yep. So that's going to be the 2023 stuff. Right. The widgets that go on sale in 2023, the factory orders. So I would say the next week, whole bunch of really big data. Market goes up if it's a lot of doom and gloom data. Market goes down if it's showing a more robust economy than any market participant wants.
Agreed. And I think Thursday is a key day with that CPI.
Finally, and thank you very much for those of you listening. This probably won't be that relevant to you. AA and I are just going to very quickly discuss some of what we're seeing on cheat sheets for premium subscribers. And I, of course, will put the links to this in your newsletter. For those of you who are interested in cheat sheets, you can go to stockcheatsheets.substack.com. I put out a free blog 3 times a week at least, with coverage of the major indexes, sectors, and subsectors. And for premium subscribers, well, you'll get a taste of what I'm about to share with you here. So let's, and AA, at any point, if you need to go, I understand, but I just want to get through this.
Okay.
Starting with relative strength, and very quickly we'll cover, I guess we should cover the global indexes. So let me do that really quick first. Make sure I have the right global index for you. There we go. So the best way to look at this sheet is start with the Chaikin money flow on the far right. If you're a bull, the thing that should get your attention is any item highlighted in green. That means that we're under accumulation, and that means the money flow is bullish. And my metric for bullish is better than 0.1. My metric for really bullish is 0.2. A 0.2 money flow score should be taken damn seriously.
Okay.
And what's interesting is, okay, and so the second thing then to look at is your eyes should look for a transition from red to green or green to red, but only you got to train your eye to kind of focus in the center of the page. We call it the sweet spot. What it's designed to do is tell you where a change in relative performance matters the most. With these two metrics, our goal is to anticipate changes in price before they happen. And generally, the first step to a new trend is an ETF or stock begins to either go down less than the market, or when the market goes up, it tends to go up more. And while it may not be doing any of those things in a sustained trend, you'll start to see a pattern emerge. And the pattern that you're looking for, if you're a bull, is higher rank on the relative strength trend in the time frames that define the sweet spot. So as an example, as we look at this, I'm going to pick item 3 from the bottom here, QID, which is the ultra short NASDAQ 100 stock. Now, AA and I just got finished talking about, it doesn't look like we're going to maybe crash through the floor right away, but overall, our assumption is lower before faster. So you're probably asking, well, why are you thinking the QID is the best candidate to talk about? And there's really two reasons. The first is that the QID actually was in a sustained relative strength move from bearish to bullish months ago. And it accomplished its objective, and we've had some spectacular moves lower. And the relative strength trend that you're seeing kind of on the left-hand side of your screen, over the past 3 to 6 months, we've averaged 9th overall. But in the days that go beyond that time period, like 100 days, 150 days, 140 days, you'll notice that the relative strength rank, when we're talking about basically the price performance of this index compared to the Russell 3000, which is the underlying benchmark we're using to test all of this stuff with, was actually higher ranked. And then about 100 days ago, or if we compare price 100 days ago to today, there was a big change from the 110-day look-back period to the 100-day look-back period. That roughly corresponds with when the market hit bottom and we started a reversal rally in the middle of June. You know, we started probably from a relative strength standpoint, probably stopped going down I'm sorry, this is a bearish ETF. So remember that QID is the opposite of the NASDAQ.
Okay.
So essentially, we went from outperforming to underperforming, and we stayed that way throughout most of the summer. Well, then September rolled around, and a couple of months ago, maybe a little less than that, our price performance started to change. And that's really what we're measuring here. So it isn't the short-term stuff that happened last week or last 2 weeks where we had the failed breakdown and then the breakup. We're thinking much more in terms of intermediate relative strength trend. And that's what we're seeing here, is that we bounced off the bottom, meaning the bottom for a short fund. And then we're seeing that relative strength is just on the cusp of getting into high single digits or low single digits, I guess, here at that 60 to 50 day period, along with trends in the short, intermediate, and long term now, as I look at trends intact, and money flow that's just north of neutral. We call this neutral plus at a 0.08, so close to 0.1. So AA, I guess my theory is here that there is eventually we're going to head lower, and the market is sort of rotating in that direction. But it's obviously, we don't have money flow that says we're about to explode.
Right. So it's not imminent is what the data is saying.
Right. That get ready, but maybe your version of get ready is pay attention to it, but don't trade it until we break down.
Yeah.
What AA and I'd like to do is do these in the money diagonals where we're long a put, and then we're writing premium outside that breakdown point. And that's what I'm doing right now. I'm actually doing it on the SPX, if you can believe that, AA. And that's worked out okay so far, wow. But it's a big number.
Yeah, SPX is a bigger product.
Yeah, it's a little outsized for my account. I'm not going to lie. So that's how to read cheat sheets. That's a perfect way of doing that. And as we look at this AA, I can tell you that I've traded successfully so far PST, where I'm doing a, I can't remember. I think I'm doing a short put.
Okay.
And I'm almost at the 50% profit level. And this says not a bad choice. Money flow. Again, we start there. Money flow. This is short. So this is short a bond fund and long interest rates. And I think AA, you're the one who told me we're approaching 4 again. Probably time to start thinking about shutting down that put, because I'm not necessarily convinced we're going to break out.
Yeah, that's the key. What do you think that 4% level gets broken or rejection?
I think that if I have enough time left, I will roll to the next strike. Well, no, I'm sorry, I'm not doing it. If I were doing it in the money diagonal, that's what I would do. Is I'd roll it now and immediately. That's what I did with a lot of the puts, like on the SPX when the short strike gave up a lot of actually got profitable on the reversal Monday, Tuesday. Mm-hmm. I didn't buy back the put, I rolled it.
Okay.
So that's my plan here. Hey, I wanted to ask you about this, what you think about this, because the numbers on the EUO, which is the ultra short Euro ETF, assuming that we bust down out from 4%, what do you think happens to the euro? Because right now we are on the precipice of a relative strength reversal. So if this ETF, this is row 14, average relative strength rank, short euro, has been fourth. But since the ECB started raising rates, you can see that in our sweet spot, we've transitioned from 4 to 10. We've hung in there at 13, 16, 13, 11. Do you think that gap between U.S. Currency values and the euro has widened as much as it's going to? And do you think so now we're weak a short euro, which means that the short euro trade isn't working as well relative to the dollar? Or do you think this is just an intermediate pullback and that there's another leg of widening ahead?
That's obviously I don't know the answer to that, but it does seem to match up with, if dollar is in fact, as you mentioned earlier in this call, the dollar is in fact going to put in a lower high. Right. And if yields don't break out at 4%, the 10-year yields don't break out at 4%, that tells me that the likelihood of euro trading higher is a high probability.
Yep. So this would be short euro. So you'd probably want to bail on this one, despite the fact that the relative strength numbers and the trends look good. The money flow actually doesn't. And that might be the tell.
Yeah. So all the pieces are kind of lining up and making sense is basically what I'm trying to say. Yeah.
Yep. Good point. So the other things that maybe look, again, we're mostly trying to focus our eyes in this zone for a big disruption, change from red to green. I think one of the things that I would say is that the VIX may not be done, and I could see a breach of support could lead to a VIX 35 to 38. I think that could easily happen, and we could see another big move up on the VIX. And it looks like traders are loading up on some VIX options here.
All year long, we're down 20%. It's been a hell of a year. We have yet to see that big VIX spike, really.
Yeah, I would think this breakdown, this line in the sand, seems to be a really big deal for the market. And I'm going to use futures here just because we may have opened.
They have actually been trading. I've been watching them out of the corner of my eye trading around.
Okay, and down we go.
Yeah, they're actually up from the low of the session.
Where they open. Okay, but here we are. There's the new futures. So again, if we are able to, the market keeps wanting to push this thing down, but it just has not. The machines have not kicked in and started shorting this thing. It's like, I don't know about you, but it's surprised. These are weeks, by the way. It's really surprised me how buoyant the market has been at this level.
That weekly candle we were just looking at from last week, tell me that's not an ominous looking, hanging bearish candle.
Yeah, let's go back
on a weekly.
Yeah. Now, of course, this won't matter. Well, this one actually to me looks like a bullish candle here because you've got the big downdraft and then you've got basically a inverted hammer here.
Mm-hmm.
Or no, is this a regular hammer?
No,
No, it's an inverted hammer, right?
It's inverted, yeah.
Yeah, inverted. So to me, that looks bullish. But what you're saying here, I think, is this is setting up, even though it's only the day before Monday.
It's 10 minutes in or whatever.
Right, 10 minutes in, that this would be an inside day, though, at support, if that's what this is. Again, that's the question is, did we break? Do we break? And so in other words, is this going to be resistance here? If that's the case, then this is a harami and we're probably headed lower. Otherwise, to me, it looks bullish.
Okay.
But it's hard for me to know because this is technically a break here, right?
Right.
Yeah. So this might be the new support and resistance range. I just don't know yet.
Right.
We need more data.
Right.
All right, let's move on though. That's the ultra shorts, but let's take a look at major indexes real quick. We're just going to focus on the big stuff now. Control minus, and I know cheat sheet subscribers, you've already seen this data. So I'm not going to go through the intermediate stage progression or buy the dip rules. You can watch the video from yesterday's blog to get all that. I think we just point out AA when we look at what's rotating into favor, it's commodities and energy.
Right. It's the same story we've been seeing everywhere
over and over
today. That's right.
Yep. And I think the repetition is helpful because it'll build conviction for a bullish energy trader. I wonder if you do some kind of pairs trade, what would pair bearishly with energy?
Oh, that's a really good question.
Yeah, it's not going to be consumer staples, although that would be a good one. I guess it would be maybe TAN. What about you do XLE versus TAN?
What about a currency?
Or a currency? That's a great idea. That's a great idea. You do bullish XLE, short euro.
Exactly. Yeah.
Or short. Well, I'm not going to do short dollar.
No.
So here we are in U.S. sectors. And again, we won't get into the mechanics of the market forecast because I've described them in such detail here. But the one thing I'd point out is the U.S. sectors, the near-term forecast is not just settling in a neutral zone. It's breaking that 20 zone, which is bearish. That can then have an impact on this fairly weakly bullish intermediate market forecast trend. So if these things stay down below 20, we can roll this over, and then suddenly we'll have intermediate forecast and long-term forecast oscillators in agreement in a bearish direction. Mm-hmm. And that, I'm telling you, when you have the two senior time frames shaking hands, all it takes then is some bearish heads up / danger zones to really wipe the market out. So I'm looking at this very nervously for bulls.
Yeah, there's trouble ahead. It sure seems that way.
And in subsectors, you're going to find the themes just recur. There's XOP and XES with the best oil exploration and production, better than energy services here at 74% tailwind score. That's because of the trend. That's the difference. Here, energy services all forecast. This is forecast, but this actually has actual trends. We had an intermediate entry signal on Friday, which means that the 10 and 40 moving average pair, exponential moving average pair crossed, making for a long-term entry signal on that ticker. All right, so that's the stuff that you've already seen. We'll do a quick look at most liquid ETFs, and we'll focus on a few things that actually I'm a little skeptical about this. Buy the dip on gold. I want to make sure we're not we're up to date here. GLD. I would not call that a buy the dip. It's not trending.
No.
But why have I got to buy the dip? Oh, I got to buy the dip because we are trending. We're above 50. This is actually a technically okay, not what I would take yet because it's only the first leg, right? I'd want to actually have a positive trend before I'm trading the trend.
Gold has disappointed me so many times this year that I'm waiting. Yeah.
But it is not a incorrect signal. So here you have, because I do not allow cheat sheets to fire a buy the dip if the intermediate line is below 50. So you have to be, we call 20 to 50, we call that neutral plus, 50 to 80, bullish, 80 and above, very bullish. And so the buy the dips signals trigger once we're bullish and over 50, blue line, intermediate line, or factor number 9 on your cheat sheets needs to finish at neutral, which it would be between 20 and 50. It needs to stay above 20. A breach below 20 invalidates buy the dip signal. And the red line came precariously close to negating itself It flashed a heads up that's below 10, but above 5, but stayed out of the danger zone. That's below 5. Technically a legitimate buy the dip setup, but AA, as I've long said, you need these factors in addition to that in order to make buy the dip work. So I'll repeat this one time. You need either factor 1 or factor 2 to be bullish. Without a trend, there's no buy the dip. So, I don't believe in buying the dip on an extrapolation. I need to see a trend. So what's that?
I was just going to add, the fact that gold has any strength to it. I agree with what you're saying about the factors, but the fact that gold has any strength to it goes again with what we were saying earlier about the euro gaining strength, the dollar perhaps losing strength along with yields.
That's right.
Those pieces still fit.
The other immutable rules that I have, which are short, besides this one's a big one, and the other one is I need buying pressure. I prefer bullish, but I will take neutral plus. I just need the Chaikin money flow to be above 0.5, preferably 0.1, especially if I don't, and I would never trade it without a trend, but I need that buying pressure to be better. The fact that the relative strength is bullish, okay, that's okay. And the fact that the intermediate and long-term forecast are shaking hands, that's a big deal. It's not a requirement for me. What is a requirement is this one has to be bullish or better. But I've traded plenty of month-long trades that don't have the long-term forecast. But when you do get long-term forecast and intermediate forecast lining up, the potential for the trend to last 3 months as opposed to 1 month is just much better, but not without a trend, not without buying pressure. Can't take this trade.
Got it.
USO, on the other hand, has the factors we need. Intermediate stage 2 trend progression is, as a review, the intermediate trend line factor 8 moves from neutral plus to bullish. So from below 50 to above 50, while the blue line must finish above 80 for a standard trigger. If you add the red line above 90 and get both of these at the same time, that becomes a strong trigger. You saw how rare this trigger has been. We've been doing cheat sheets for several months now. And last Monday on some of the energy ETFs was the first time I saw a strong trigger on intermediate trend progression signals. It's one of the reasons I took XLE and XOP both.
Okay.
Finally, oil services. And I just keep varying the tickers so that you can see the liquidity. On subsectors, we put an XES here because it's a liquid ETF. I put an OIH. 51% tailwind score, one of the two trends in effect, and that's because of this signal. It's the crossover signal that we just talked about.
Okay.
All right, moving on. This is just something I'm not going to spend too much time on, but we can maybe, if I had more time, could take a practice trade. This is a list of approximately 30 fundamentally sound ETFs. We're using a combination of Fidelity has their version of a tailwind score. TD Ameritrade has another set of research. I factor in Chaikin Analytics, but don't use it exclusively. I want to be clear about that. This is not Chaikin data. But I use a number of different things to find a collection of stocks that has a combination of higher cash flow, better price to sales, analyst upgrades, where estimates are going up, and insider buying, and or a performance of earnings beats. And the more of those things that are there, the more likely it is to make the cut. And this, of course, is S&P 500 stocks only. So these are the best of the best from a fundamental standpoint. And you can see a number of them are uptrending and buying signals for long-term and medium-term with decent buying pressure, good market forecast agreement, momentum and or near-term forecasts that are going, above 80 or above 90. So I think AA, you've seen enough of these cheat sheets. You've seen enough Chaikin data to know that this is a good work list. And if the market does decide to go into a Santa Claus bear market rally, these would be some of the stocks I'd be looking at.
I agree with that. Yeah.
And this is exclusive to holders of cheat sheet premium accounts. All right. Disruptive Tech is next. This is the Cathie Wood Fantasy Fund. We have her fund here as well, but very little in terms of disruptive tech is, it looks like I've got commodities in here by accident. Oh, I am looking at commodities. Let's spend a little bit of time here, AA.
Okay.
So buying pressure, well, let's start there. What's got the buying pressure? Well, natural gas, the the liquid fossil fuels. This is biofuels. Down here, we've got JJC is, what is that? It's not coffee.
It's not coffee. Let me look.
Yeah, I can't remember. I hate the names they give some of this stuff.
Copper?
Copper. That's right. Copper. So we've got, I would say, some decent, but not yet broken out tailwind scores. They're below 50, but energy, palladium, which of course is used in catalytic converters, and I believe it is part of the battery, the electric car supply chain, is it not? Palladium? I think so.
I think so, but I'm no expert.
Yep. And then we have dollar strength. Of course, I put that on just to compare it and notice that no commodity except natural gas is outperforming. We have a weird market forecast on natural gas. Don't you find that interesting?
I do. Let me look here. That's another one of those positions I have on that is currently not working.
Well, and this is why. There's the market forecast. So the long-term sentiment rolled over recently.
Mm-hmm.
I find these things tend to be bullish in run-ups to seasons, and like the run-up to the air conditioning season. But once air conditioning season kicked in, down they go. Then the run-up to the cold weather, down they go.
Yeah.
That just seems to be the cycle. However, I would say we are making lower highs here, but higher highs here on the near-term oscillator. So we may be at the end of the downdraft. I mean, what are you doing? An in the money call diagonal? What was your?
That's exactly right.
So you've been rolling the whole way down, and have been able to keep up with your cost basis. It's kind of hard because the lower you go, the greater the possibility of getting cut off, right?
Yeah. No, it hasn't worked well at all, actually.
Yeah. Well, but that's defined risk, right?
Yeah.
So if you set yourself up for $500, the risk is the same here and here, and now
That's
you probably have better. Are you overwritten currently and deeply in the money on your overwrite?
No, I'm not overwritten because it lost all its extrinsic value.
Got it. Okay. Well, that makes sense. And but I would say you do have maybe it would have been nice if this blue line, near-term line, had kept up its divergence, but clearly here in the into the close, we finished below 5. So unfortunately, that trade may have some further downside to go.
Yeah. Blow it up.
Yep. And that's, again, the one thing you want to look at, although it's not showing up here. So it must have been the day before. But okay. That is a tell for trend trades. It's hard to win when you have those two oscillators agreeing with each other in the opposite direction.
In the wrong way, right.
It didn't start that way, AA, though. I know why you got into the trade.
Yeah.
Yep. All right. Let's see if there's anything else. Here we see gasoline, which I am bullish on, has one of the two factors we need, to take any kind of trend trade. This is actually a long-term entry signal. Not my favorite for commodity-based ETF trades. I think long-term is nice. It's just telling you the long-term average is there, but I would probably want a different catalyst to trade this just because commodities tend to move quicker than weekly moving averages. Okay. Palladium's a buy the dip. Let's go through that and see if it's worth it. So 53, check. One of the two trends, check. Buying pressure, neutral minus. That keeps me out of the trade.
Okay.
And then buy the dip down here on wheat. Okay, we got one of the two, check. Buying pressure, neutral plus. Okay, we're not totally kicked out yet. I don't necessarily care about multiple time frame relative strength on a commodity. It trades differently than stocks. The long-term and the intermediate forecast agree. In fact, the intermediate forecast is very bullish, and we have no negatives. So that means we got a successful buy the dip. That's got my attention enough to at least go look at it. WEAT. And there's a nice trend emerging. Let me get rid of this horrible, whatever that Fibonacci extension I drew here. So a moving average cross. We're not in a long-term uptrend, but we're in a short-term one. Pull back to the 40. Why is that showing? That's not very bullish, right?
Yeah, down below the 80, right?
Yeah, let's go back and check that. I might have a calculation issue. What was that, WEAT?
Yeah.
Intermediate forecast is not very bullish. Not at all, right? Unless I'm missing something here. What am I doing wrong? WEAT. Unless
you're on the daily.
Yeah, I'm on the daily. Well, that upsets me. What's going on here? Other than I wonder if there's, okay, here's what's possibly happening. It could be one of those widened bid-ask spreads that I'm catching. That's caught me before. So 892, 894, 904. So indicated to open higher. But sometimes the numbers on the actual cheat sheets reflect intraday. So I'll tell you what, I will recheck this when market opens. Don't lose faith in my cheat sheets yet. It's most likely a widened bid-ask spread.
Got it. Okay.
But not necessarily. I'm going to go look at it.
Okay.
Because that is a shit detector. And then the only other thing I could do is, oh, you know what? I got the wrong. Oh, no, I'm looking at the right one.
Yeah.
Let me copy. Let me make sure there isn't an erroneous data issue here. Let me also make sure that I actually updated these. That's the other thing I want to check. Is I may. Oh, you know what? I haven't updated this. It's Wednesday, October 5th.
Got it. There you go. There you go.
Shoot. Sorry about that. Okay. And this is Wednesday, October 5th. So I apologize. I think I just wasted a lot of time here. Dividend dominators. I don't think I have that updated yet. There's always a reason, but
yeah.
I think we just wasted a lot of time, so I'm not going to waste any more of your time. Cheat sheet subscribers, I'm sorry. I'll put a note in so that you don't get burned trading on old information. I know that the sector, subsector, and index ETFs, the most liquid, and the shorts were up to date, though.
A good run through the exercise, though, despite the fact that maybe
some of the data is out of date, and I'll make sure that we don't post that.
Okay.
Or we're going to post it, but I'm going to put a note up saying, don't listen to that. Right. That was a huge shitload of stuff to cover. I think we can give everyone and ourselves a break, and I'll see you next week.
Yeah, we will. We'll reconvene post CPI, and we'll have a lot to talk about, I'm sure.
For those interested in a Chaikin Analytics subscription, visit chaikinanalytics.com. If you'd like to listen to the Macro Monkeys podcast, AA, the best place to do it is wherever you pick up your podcast.
Wherever you pick them up, and if you like it, subscribe to it and give it a review if you wouldn't mind.
Yeah, give us a good rating. Hopefully,
yeah.
we worked hard up until we fucked up the last 10 minutes of the thing. And I curate cheat sheets, and I can be found at stockcheatsheets.substack.com.
Until next week, Mike.
We'll see you then. Thanks, AA.
Thank you.